Guys, 10 semiconductor stocks we're going to put in the stock analyzer tool. What should we pay for them today? Semiconductors are huge, having a great couple of years, a lot of growth potential as the word gets better. First one, Micron. So guys, I'm going to go to the 8 pillars. If you're a subscriber to our software, please follow along all 10 of these. If you're not a subscriber, grow up and sign up. So Micron, let's go to stock analyzer tool. Boom. Now, for those of you who are new to this, we look at the 1, 5, and 10-year numbers here as a guide for the future. But remember, companies probably not going to go to the same level as it did before. My job is to be conservative, put in conservative assumptions, and then hopefully buy at prices lower than the conservative assumptions. So I'm going to go in at 5, 8, 11%. Profit margin. Ooh, big differences. I'm going to go 26, 28, 30. Free cash flow margin. Oh, I don't like that big difference there. 11, 13, 15. PE. 13, 15, 17, 13, 15, 17 on price of free cash flow. 12.5% return. Micron's currently at $74. Oh, holy cow. A low of 40 to 100, a high of 100 to 200, big ranges because that free cash flow difference right there, guys. So pick one of them. This is looking pretty decent. Next stock, Tim, what is it? TSM, guys, Taiwan Semiconductor. Right here. Whoa, big drops again. You're going to see that pretty much throughout all the semiconductors. It has a high of 145. Let's go to the 8 pillars. Oh, wow. Okay. Stock analyzer tool. So revenue growth. I'm going to do 5, 8, and 11. I'm pretty much going to be consistent with that. Every company except for the really, really big ones. Profit margin. 33, 35, 30. Actually, I'm going to go 32, 34, 36. Free cash flow. 20, 19, 21, and 23. I think I know why the free cash flow is lower. These companies are probably investing into more infrastructure to be able to meet demand. So you're going to see a hit to free cash flow. PE, 13, 15, 17. 13, 15, 17. And a 12.5% return. Analyze button. $96 current price. Okay, this one's not as exciting. We have a low of 30 to 50, a high of 65 to 100, and in between is 45 to 70. So we could see a little bit of a drop here. I would focus more on the earnings on these last two companies because of the fact they're probably depreciating a lot as they spend their free cash flow in the future. Next company, MRVL, Marvel. Marvel does $50 billion in market cap, $5 billion in revenue, did not have profit last year. So again, same thing as before, big drop in stock price. Oh, wow, look at the 10-year revenue growth numbers. So big numbers in the last 5 years. So I want to understand why that is. So I'm going to go a little bit more conservative on this guy, but also put a little bit more in on the high end. Profit margin. Ooh, this is interesting. I'm going to go 4.5, 5.5, 6.5. Look at that free cash flow. This is a little bit different now. Free cash flow is very high here. So guys, be careful on this one. The numbers are all over the place. Make sure before you buy this company, you do a lot more research to understand why everything is all over. Free cash flow is much higher than their profit. I'd rather see that than the other way around, but still, keep that in mind. Maybe they invested a lot before and they're depreciating the stuff they did before and their CapEx has dropped. Who knows? So free cash flow, I'm going to go 13, 14 and a half, 16. PE, 13, 15, 17, 13, 15, 17. You're going to see big differences here again. 12.5% return. The stock is currently around 60. Oof. Rough. Even the free cash flow numbers. Guys, this is just tough. You sit there and say, how can that be? Well, guys, it's just numbers. At the end of the day, it's just numbers. If they're not growing a ton, it's hard to make it happen. So I'm personally just going to ignore Marvel, but if you want to look at it further, please do. Next company, TXN, Texas Instruments, $165 billion market cap, $19 billion in revenue last year, some stable free cash flow. Let's go 8 pillars real quick. Everything's a check except for the 2 X's on valuation. Let's go to the stock analyzer tool. Guys, Texas Instruments is a big company. I'm going to be extremely conservative on their growth potential because look at this growth in the last 10 years. The last 1 year was a big jump, but I'm going to ignore that. So I'm going to go 2, 4, 6% revenue growth. Profit margin, 30, 32, 34. Actually, 32, 30, 33, 36. Free cash flow margin, 32, 34, 36. PE, definitely 13, 15, 17, and 12.5% return on my company. 177 is the current stock price. Guys, it's got to fall. 66 to 122. Somewhere in the middle is around 90. It's got to fall in half. Now, you're probably new to the channel and going, nothing's a buy. Guys, be patient. There will be a time in the future where you're like, Paul, why do you say everything is a buy? It's just very, very hyped right now. That's fine. It's fallen a lot. Might need to go further. Look at Peloton. Look at Palantir. Look at all those companies that nobody thought would fall 80, 90%, and they did. You'll have better buying opportunities in the future. Next company, Applied Materials, AMAT. These guys are a supplier for semiconductors. Stock hit a high of 167 last year. Now it's at 118 after a low of 101. Quick look glance at their 8 pillars. Guys, all these companies these 8 pillars are valuation metrics are the bad ones. The rest of it we all like. They're buying back shares. Let's go to the stock analyzer tool. Good revenue growth. But again, I'm going to go conservative. 6, 9, 12. Profit margin. I'm going to do 19, 21, and 23. Free cash flow margin, 19, 20, and 21. PE, 13, 15, 17, 13, 15, 17 on price of free cash flow. And you guys know I want my 12.5% return. Analyze, 118. Okay, we're not far off here. The middle one is 110 to 115. The low is 77. The high, if you believe these numbers, are a buy all day. Just in the time we started watching it, it's fallen quite a bit. Fallen 1%. So, guys, this is one. Add to your watch list at the 114 mark and start doing your research right now. Start doing more research on it because this might be a good opportunity. Next company, AVGO, same thing, Broadcom. So high of 677, low of 455. It's currently at 583. So it's really bounced off this low right here. But the market's seen a big surge in the last week or two, so that explains it. 8 pillars. All right. So they've issued a few more shares. Not a big deal, only 1.2%. Net income is down. Valuation metrics on PE. So their free cash flow is better than their earnings. So let's go to stock analyzer tool. Ooh, look at the revenue growth. 32% in the last 10 years. 32% a year. Wow, big stuff. 6, 9, 12. Profit margin, 20, 22.5, 25. Look at this free cash flow number. 36, 39, 42. PE, 13, 15, 17, 13, 15, 17, and a 12.5% return. Now, guys, a lot of you are probably wondering, how are you coming up with these numbers? I'm just literally looking at this and picking numbers. My goal is to find companies that are selling close so I can do more research. But if I have to make it work by putting high numbers in, that's not the way to do investing. The way to do investing is it's so obvious to you to do more work. That's the way you do investing. Don't sit there and force the deal to happen. Do conservative estimates, and when it's like, oh, wow, what am I missing here? That's when you do more research. So hit the analyze button. Company's currently at 583. Okay, not as bad as I thought. We have a low of 205, a high of 773, and the middle range is where it was recently, somewhere in the middle of 300 and 500. So maybe when it hits 400, you want to do some more research. So I'm going to go pick a 460 number. Notify me. Let me know when it's there. That way I can start doing more research. But this might be a good time to look at this one. Next company, QCOM, Qualcomm. Okay. High of 193, a low of 122, and it's currently at 142. 8 pillars, our favorite 8 pillars, guys. Valuations, the reason we love these is it's just a matter of waiting for the price to fall. And prices fall a lot easier than they go up. All right. Now, stock analyzer tool. Big growth in the last 5 years, slower growth in the last 10 years. So their growth is picking up, but I'm still going to be conservative. I'm still going to go 4, 7, and 10. Profit margin, 16, 18, 20. Free cash flow margin, 16, 18, 20. Anytime I can have them be the same, it's awesome. PE, 13, 15, 17. Price to free cash flow, same thing. 12.5% returns. Current price, 142. All right. So if you believe these high valuations, go do your research. Do whatever you want there. Low side, it's got to fall in half. The middle, 104. Okay, so I'm sitting here saying, all right, maybe I want to pay attention to this thing when it hits 115. So I'm going to add this. I'm going to hit 115, notify me. I just want to sit there for a company like Qualcomm, be there and be ready when the time is right. It can happen. It will happen. It's always happened in history where amazing companies sell at prices you go, why are they there? Next company, Intel. Now everybody knows about Intel, biggest player in the market. This company, considered dead by so many people. Look at this. I love showing this chart. This goes back to 2000. This was literally the stock of 2000 along with Cisco. It has not reached that in 20 some years. That's what I mean, guys. If I told you back here it wouldn't reach its high, it still wouldn't have a high 22 years later. You'd be like, you're crazy. That's the point of what I mean when I say be patient. Stocks will fall a lot faster. And then you'll be crazy for not owning Intel. So they did a $77 billion in revenue with a $180 billion market cap. 8 pillars. The only thing we don't like is their cash flow. But remember, guys, there's a story here. The company's come out saying we are investing big in our future. We're investing in factories. We're going to take everything. We're going to be number one manufacturer of chips in the United States. They're investing in their future. Let's go to stock analyzer tool. Now, guys, on this one, I'm going super conservative. I'm going 0, 2, and 4% revenue growth. Profit margin. I'm doing 23, I'm doing 22, 23.5, and 25. Free cash flow margin. I'm going to do 18, 20, and 22. PE, 13. I'm going to even go more conservative. 12, 14, 16, 12, 14, and 16, and a 12.5% return. Guys, the stock is currently at 44 bucks. Okay. You're basically here in the middle range, high side and the low side. And guys, the high side is only 4% revenue growth. 4% revenue growth. They own their foundries. They make their own chips. It's easier for them to meet bigger supply requests in the future when they own their own chips. They're setting themselves up to be the go-to chip manufacturer in the world at some point. Is that going to happen for sure? No. But if they can buy back shares, pay out cash, pay good dividends, do all that stuff, it could still be a good return. Do more research on Intel. Next company, AMD. Now, AMD is the big competitor to Intel. These guys have been unstoppable. 165 high, a low of 78, recently at 104. 8 pillars. Now, here's the ugly part about AMD. Look what they're doing here. They are diluting the hell out of people. Why? Because their stock is so expensive, and the smart guys in the office go, why would we ever put debt in the company? Let's just finance everything we're doing by issuing shares, because all these kids out there love our company and want to just keep buying our shares. Let them have it. They're going to do that. Higher debt relative to free cash flow, but I would look at their free cash flow as it's still in early stages, so this doesn't bother me at all. Let's go to the stock analyzer tool and determine what this company is worth. Now, I'm going to go 8, 11, and 14% revenue growth. Profit margin, I'm going to do 14, 17, and 20. Free cash flow margin, I'm going to do the same thing, guys. 14, I think AMD has a lot more free cash flow and profit to give than their history has shown. PE, this is where everybody's going to hate me. I'm going to give 14, 16, 18, and I'm going to do 12.5% return. Guys, if you hate me for this, I don't know what to tell you, but I've seen it 1,000 times when companies don't hit their metrics. AMD has been the one that's supposed to take over Intel for the last 25 years, and it still hasn't happened. Does that mean it won't happen? No. But again, be conservative. The stock's currently at 103. Hit the analyze button. Okay, we're not far off the high level, but the low level, we're really far off. In the middle, it's got to fall in half, in my opinion. You think I'm crazy? I don't blame you. I'm going to sit here and set my reminder for 83. Notify me. There might be way more potential in this company, but that's where I stand. Go do your research. Final stock, NVIDIA. These guys make great graphics processors. NVDA. Guys, look at this stock. 346, 52-week high. Recently hit a low, 8 pillars. So they've issued more shares, but apart from that, look at these valuation metrics. 94 times their last 5 years profit, 98 times their 5-year free cash flow. Everything else, I mean, look at this adorable dividend, 0.1%. This is so cute. Okay, let's go to the stock analyzer tool. Guys, by the way, this is a company that does $30 billion in revenue. So it's a big company here. It's not small. Revenue growth, 8, 12, 16. So keep in mind, 16% revenue growth for 10 years would take their $30 billion to $132 billion, which is almost double what Intel is. So that's a big number. So keep that in mind when you're doing these things. 26, 28, and 30, 26, 28, and 30. PE, I'll give it 14, 16, 18, 14, 16, 18 for all you people who think I'm a hater. 12.5% return. The stock's at 188. Guys, it's got to fall easily in half. We're at 50 here, 127 here, 82 here. Guys, do your homework. Think about it logically. Thanks very much. Enjoy your time.